Okay, let's start some exercises out of Chapter 2. The first one I assigned was exercise 2-1 on page 90. It's entitled Chart of Accounts. Identify each account as either a balance sheet or an income statement account. And then for each balance sheet account, identify if it's an asset, liability, or equity. And if it's on the income statement, is it a revenue or an expense item? So if you go through this list here, and I've provided you the solution, all items are going to show up either on the balance sheet or the income statement. And on the balance sheet here, we've got our assets, our liabilities, and our equity. And this problem actually has no equity items, but if you notice, there's assets and liabilities. And on the income statement, there are only two items, revenues and expenses. I will say that this is a good exercise. The only thing I would caution is Delta Airlines is a unique industry in that some of the titles of these accounts are somewhat confusing when you're still trying to learn accounting. So for instance, let's just pick on one here. Frequent flyer obligations. It's on the second column there. Frequent flyer, and it's an obligation. Well, an obligation is like an accounts payable. We owe it, and that's why these folks that earn all these frequent flyers and they're going to take some airfare someday down the road, that's a liability. We will owe that to them at some point. There are other items in here that are probably just as confusing. I'm not going to go through them, but this problem is just short of we want to have items on the balance sheet and the income statement. If it's a balance sheet, it needs to go into one of these categories, assets, liabilities, or equity. If it falls on the income statement, it's going to be classified as revenue or expense. Moving to number 4, it says the following table summarizes the rules of debit and credit. For each of the items, A through L indicate whether the proper answer is a debit or a credit. All right, well, in this exercise, it's just simply identifying is it a debit or a credit. Well, an asset. Well, in the reading, we learned that every account has the opportunity of being debited or credited. And the best way to remember, do you debit or do you credit it, is do you want to increase it or decrease it? Well, an asset, in order to increase an asset, its normal balance is a debit, so you need to debit it to increase it. If it's a liability, it's just the opposite. The normal balance is a credit, so in order to increase the liabilities, you need more credits. And that's the exact same way for equity. If you need to increase equity, you need more credits. Income statement. Revenues are always credits. Expenses are always debits. So in order to add more to a rent expense account, you need to debit that account because expenses are debits. You have more revenue, you sold more items, so you need to increase your revenue account, you need more credits. So the normal balance is what you need to do in order to increase the account. So let's look at an asset. Well, if the decrease in that one is a credit, letter A has to be a debit. And an asset's normal balance is a debit, so letter B is also a debit. And to increase an asset, you debit it, so the normal balance has to be a debit. Letter C, liabilities. Well, if we want to decrease it, it then is a debit. Letter D, let's look to the increase column. That's the normal balance, so letter D is a credit. Common stock, to decrease it is a debit. However, to look at its normal balance, it would be a credit. Letter F is a credit. Retained earnings. Retained earnings, letter G. Letter G. To increase it is a credit. Letter H, to reduce it, a debit. Dividends, letter I, a debit is the normal balance, right? We'll talk about that later. Income statement accounts, revenues. To increase it is a credit. To decrease it, it has to be a debit. And expenses, letter L, in order to increase it, it has to be a debit. As simple or as minor as this exercise is, I can't stress enough how important this one is. It's really the backbone of everything. So take time to really think through this. What is the normal balance? Well, then that's how you increase it. Opposite of that would be to decrease it. Number 5, it says here, during the month, this company has a substantial number of transactions affecting each of the following accounts. State each account whether it is likely to have a debit only, credit only, or a debit and credit type of entries. And let's step back here and think about that for a moment. In summary, I would tell you this, or in general. Income statement accounts, every time you sell something, it's a revenue, it's a credit. That will be 99.5% of the time. Revenue accounts are typically only credited. When would you debit a revenue account? The example would be when the customer returns something. You reverse what you did, or you made a mistake and you just reverse what you did. But generally, you will always credit a revenue. Likewise with an expense. Every time you have an expense, you will debit it. The only time I can think of you crediting it is if you made a mistake and you reversed it. That's the income statement. It's usually one direction. It's always either a credit or it's always a debit. Now the balance sheet, that's a little different. Balance sheet accounts, you will debit and credit them. Let's pick on cash. Every time you make a deposit to cash, you will debit the account. Every time you write a check, you credit the account. So balance sheet accounts usually go both ways, debits and credits. Let's look at accounts payable. People you owe money to. Every time you charge something, you will increase. You will credit accounts payable. Every time you pay off that liability, you will debit that account to reduce it because you don't owe it anymore. So balance sheet accounts typically have debits and credits going to the accounts. So having said that, number 1, accounts payable. Notice there, debits and credits. It's a balance sheet account. Accounts receivable, same thing, balance sheet, debits and credits. Number 3, cash, debits and credits. Number 4, really credit entries only. Insurance expense on the income statement, debit only. Dividends. Referring back to exercise number 4, when I said, we'll talk about that later, and it said increase, you debit it. Decrease dividends, you credit it. What's the normal balance? Debit. Well, I would agree with number 5 here, number 6 actually. It's always a debit. You never send out the dividends, debit, dividends, credit, cash, and then 2 months later say to the owners of the company, I need the dividend back. That typically goes one direction. It's always a debit. You will never be able to say, oops, I made a mistake, I need it back. You won't get it back. It's always a debit. And number 7, likewise, expense, debit. Number 6, it reads, what's the normal balance? Identify each of the following accounts as asset, liability, equity, revenue, expense, and what's its normal balance? Well, again, accounts payable, it's a liability. What's its normal balance? A credit. Accounts receivable is an asset, so it's a debit. Letter C, cash is an asset, it's a debit. Letter D, common stock, that's equity, it's a credit. Letter E, dividends, it's in your equity section. it's a debit. Fees earned, it's revenue, so it's a credit. Land, asset, debit. Expense, expense is a debit. Supplies is an asset, debit. And utilities expense is on the income statements as an expense, therefore it is a debit. We will take a break here for a minute and we'll resume here on the next video.